Right now, millions of Americans are working harder than they ever have in their entire lives, and somehow, they're still falling behind. Not because they're lazy, not because they're careless with money. Most of them pay every bill on time. They don't gamble. They don't blow their paychecks on nonsense. So why does their bank account look exactly the same as it did 5 years ago? Sometimes worse? Here's the uncomfortable truth nobody wants to say out loud. There are 10 specific mistakes, quiet ones, almost invisible ones, silently draining people dry in 2026. And the scary part? Most people are making at least 3 or 4 of them right now, without even knowing it. By the end of this video, you're going to look at your own money completely differently. Some of it might sting a little. That sting is usually the first sign that something is finally about to change. Before we go any further, I need to ask you something honestly. If even one of these 10 mistakes sounds a little too familiar, that's exactly why this channel exists. We break down money, real money, the kind that actually affects your life, without the jargon, without the sales pitch, without pretending it's simple when it isn't. So if you want to keep seeing the truth about money laid out like this, clearly, honestly, no fluff, hit subscribe right now. And tap that notification bell too, because the next video might be the one that changes how you think about your entire financial future. It costs you nothing. But skipping it might cost you more than you think. Something strange is happening in millions of American households right now, and almost nobody is talking about it. People are working harder than ever. Longer hours. Second jobs. Side hustles squeezed into weekends. And yet, somehow, their bank accounts look exactly the same as they did 5 years ago. Sometimes worse. Here's the part that should really bother you. It's not because they're lazy. It's not because they're bad with money in some obvious, dramatic way. Most of these people pay their bills on time. They don't gamble it away. They don't blow it all on luxury vacations. So what's actually happening? The truth is uncomfortable. There are specific mistakes, quiet, invisible, almost socially acceptable mistakes, that are draining people dry in 2026. And the scary part is, most people are making at least 3 or 4 of them without even realizing it. Think about that for a moment. You could be doing everything right by society's standards and still be falling behind, simply because nobody ever warned you about these traps. By the end of this video, you're going to see your own financial life differently. Some of what you hear might sting a little. That's okay. That sting is often the first sign that something is finally clicking into place. Let's start at the very beginning, with a mistake so common that almost everyone reading this has done it this month. Mistake number 1 is treating a paycheck like it's meant to be spent completely, every single time. Here's how it usually plays out. Money comes in. Bills go out. Whatever's left gets absorbed into daily life. A nicer dinner, a subscription renewal, we deserve this purchase. By the time the next paycheck arrives, the previous one has vanished completely. And here's the surprising part. This isn't happening because people earn too little. Plenty of people making 6 figures are stuck in this exact same cycle. Income goes up, and spending quietly rises right along with it. Psychologists call it lifestyle creep. It's sneaky because it never feels like overspending in the moment. It feels like simply enjoying life a little more. But that's not all. The real danger isn't the spending itself. It's what it prevents. Every dollar absorbed into daily comfort is a dollar that never gets the chance to grow. And growth, over time, is the entire game. Let that sink in for a second. Now let's move to mistake number 2, and this one is a big one in 2026 specifically. It's ignoring the true cost of debt, especially the debt that feels normal. Credit cards. Buy now, pay later apps. Auto loans stretched out to 7 years just to make the monthly payment look smaller. None of this feels dangerous in the moment. It feels convenient. Responsible, even. Here's where things get interesting though. The interest rates attached to a lot of this debt in 2026 are brutal, often 20% or more on revolving credit. That means for every $100 carried on a balance, a household could be losing $20 a year just standing still. Not spending it on anything. Just paying for the privilege of having spent money they didn't actually have. Most people don't realize this part. Debt doesn't just cost you money. It costs you time. Time you'll spend later, working to pay off decisions made months or years earlier. It's like running on a treadmill that someone else controls the speed of. And here's where the story takes a surprising turn. The people who struggle most with debt aren't usually the ones who are reckless. They're the ones trying to keep up, trying to look financially stable in front of family, friends, and social media, while quietly falling further behind in private. Now, let's talk about mistake number 3, because this one hides in plain sight. It's not having any real emergency fund. Picture this scenario. A car breaks down. Or a medical bill shows up out of nowhere. Or a job gets eliminated with 2 weeks' notice. For someone with even a small cushion saved up, this is stressful, but survivable. For someone without one, it can be the beginning of a downward spiral that takes years to climb out of. Believe it or not, most Americans in 2026 still could not cover an unexpected expense of even a few $100s without borrowing money or putting it on a card. Let that sink in. Not a luxury emergency. A basic, everyday life happens kind of expense. Here's what makes this mistake so devastating. It forces people into debt at the worst possible moments, when they have the least amount of leverage and the most amount of stress. And once that debt starts, it often just keeps compounding, mistake number 2 feeding right back into mistake number 3, in an endless loop. But then something changed for the people who figured this out. They didn't need to save a fortune overnight. They simply started treating their emergency fund like a bill that had to be paid every single month, no matter how small the amount was at first. And slowly, that small cushion became the difference between a bad day and a financial disaster. Now here's mistake number 4, and this one might surprise you, because it doesn't look like a mistake at all. It's keeping too much money sitting completely idle. Some people are actually good at saving. They avoid debt. They live within their means. And yet, they still fall behind, because their money is parked in a regular checking or savings account earning almost nothing, while inflation quietly eats away at its value every single year. Here's the part most people miss entirely. Money that isn't growing is technically losing value. If prices rise faster than your savings account pays you interest, then every year, that money buys a little bit less than it did before. It looks the same on the screen. Same number. Same balance. But its actual power in the real world is shrinking. That should feel unsettling, because it means simply, saving isn't enough anymore. Saving protects you from emergencies. But it doesn't build wealth. Only growth does that. And growth requires the money to actually be put to work somewhere. Which leads us directly into mistake number 5, one of the most costly of them all. Waiting too long to start investing. Here's a scenario that plays out over and over again. Someone in their 20s says, "I'll start investing once I make more money." Then their 30s arrive, and they say, "I'll start once things settle down." Then their 40s hit, and suddenly there's a quiet panic, because retirement doesn't feel as far away as it used to. Now wait a second, because this is where the numbers get almost unfair. Money invested early doesn't just grow. It grows on top of its own growth, year after year. Two people investing the exact same amount, but starting just 10 years apart, can end up with wildly different results by retirement age. Not because one of them was smarter, simply because one of them started earlier. Most people don't realize this part until it's almost too late. Time in the market matters more than the amount of money you start with. A small amount invested early can outperform a much larger amount invested late. That's not motivational speech. That's just math, and it's merciless. At this point, things become impossible to ignore. Every year someone waits to start isn't just a delay. It's a permanent loss that can never be fully recovered, no matter how much extra they try to invest later to catch up. Let's move to mistake number 6, and this one hits especially hard in 2026. It's underestimating how much healthcare and unexpected medical costs can destroy a financial plan. Here's the uncomfortable truth. Even people with insurance are regularly blindsided by bills they never saw coming. A hospital visit, a surgery, a prescription that isn't fully covered. These expenses can appear suddenly and completely upend months or even years of careful saving. And here's the deeper issue. Most people build their financial plans assuming good health forever. But life doesn't work that way. Ignoring this risk doesn't make it disappear. It just means it hits with more force when it eventually shows up. The people who protect themselves best aren't the ones who never get sick. They're the ones who plan as if something unexpected could happen, because eventually, for almost everyone, it does. Now here's mistake number 7, and this one is deeply tied to mindset. It's comparing your financial life to everyone else's highlight reel. Social media has quietly rewired how people think about money. Vacations, new cars, renovated homes. It all looks effortless online. But here's what most people don't see behind those photos: debt, finance purchases, and financial stress hidden just out of frame. Honestly, most people don't realize how much of their spending is driven by comparison rather than actual need or desire. Buying something not because it improves your life, but because everyone else seems to already have it. And here's where the emotional damage really happens. This constant comparison creates a feeling of being perpetually behind, even when someone is actually doing fine. That feeling pushes people to spend more, just to keep up with an image that, in many cases, isn't even real. Let that sink in for a moment. The person you're comparing your finances to might be drowning in debt behind the scenes. Comparison, in the world of money, is almost always comparing your real life to someone else's carefully edited illusion. Now let's talk about mistake number 8, one that quietly limits people for decades. It's never increasing financial knowledge beyond the basics. Here's how this usually unfolds. Someone learns just enough to get by, how to use a checking account, how to make minimum payments, maybe how a basic savings account works. And then they stop learning. Financial education becomes something that ended back in their 20s, if it ever really started at all. But that's not all. The financial world doesn't stand still. New tools, new investment options, new tax rules, new risks. People who stop learning don't just miss opportunities. They become easier targets for products and decisions that quietly work against their own interests. Here's where things get interesting. The people who build real wealth over time aren't necessarily the smartest people in the room. They're often just the most curious. They keep learning a little bit, consistently, over years, until that knowledge compounds into genuinely better decisions. Now, mistake number 9, and this one might be the most emotionally charged of them all. It's making financial decisions purely based on fear or panic instead of a clear plan. Picture the stock market suddenly dropping. Headlines scream about a crash. Fear spreads fast. Some people panic and sell everything, locking in their losses permanently. Then, months later, when things recover, as they historically almost always do, those same people are left watching from the sidelines, having turned a temporary dip into a very real, very permanent loss. Most people don't realize this happens because of instinct, not incompetence. Humans are wired to protect themselves from threats. But financial markets don't respond well to panic. They respond to patience. And here's the twist that surprises so many. The people who tend to do the best financially aren't the ones who never feel afraid. They're the ones who have a plan built in advance, so that when fear inevitably shows up, they don't have to make life-altering decisions in the heat of that emotional moment. Now we arrive at mistake number 10, and in many ways, this one ties every previous mistake together. It's never clearly defining what financial success actually looks like for their own specific life. Here's the problem. Without a clear personal definition of success, people simply chase whatever seems impressive at the moment. A bigger house, a newer car, a more expensive lifestyle. Not because it truly makes them happier, but because it looks like what success is supposed to look like. Here's where things get genuinely interesting. The people who feel most at peace with their finances aren't necessarily the wealthiest. They're the ones who took the time to define what enough actually means for their own life, and then built their spending and saving decisions around that very specific answer. Without that clarity, more money almost never solves the underlying problem. It just raises the size of the lifestyle being chased. So here's the real question hiding underneath everything we've just walked through together. If these mistakes are so common and so damaging, why does almost nobody talk about them clearly? Part of the answer is uncomfortable. Confusion around money benefits certain systems. Debt is profitable for someone. Impulsive spending fuels entire industries. Financial confusion keeps people locked into decisions that quietly benefit everyone except them. But here's the hopeful part, and it's important. None of these 10 mistakes require becoming a financial genius to fix. They mostly require awareness, small consistent changes, and the willingness to challenge decisions that have simply become automatic over time. Think about that for a moment. You don't need a six-figure salary to escape this cycle. You need clarity. You need a plan. And most importantly, you need to start, even in some small way today. Because here's the truth that ties this entire story together. The gap between people who build real financial security and those who don't isn't usually about intelligence, or luck, or even income level. It's about awareness, and the courage to make different choices once that awareness finally arrives. You've just spent the last several minutes gaining exactly that kind of awareness. What you decide to do with it next is entirely up to you. And that, right there, might be the most important financial decision you make all year.